Hey there, and welcome to today's episode of the Money Talks and So Do We's podcast. On today's episode, I'll be joined by some very special guests from our exec team who will help explain some tricky finance and economics concepts to help you revise before your final exams. And after that, we'll also be discussing choosing courses, choosing a major, as well as general exam study tips and case comps.
Hi, my name is Hung and I'm the VP of Pubs. I'm also a third year BAPE student, and today I'm talking about case comps and general exam study tips. Alright, so first, when you get a case, there'll be maybe 1 or 2 information sessions, but from there, there's a week until submissions. So to make each of your day count, it's important to break the week into phases and put rough dates on each of the phases as a group. So first is the ideation phase. So you want to start researching immediately and then have your ideas and thesis finalized by maybe day 2 or 3. I think it's just better to get something down on paper because you can always revise it once it actually exists. And then from there, you want to build out a story, which I will touch on a bit later, but it's good to just be able to allocate people across the individual sections, break down your task, and then finish the deck as early as you can so that you have at least half a day's buffer between when it's done and the submission time so that you can check over any details and anticipate any gaps and questions. Alright, so when you are finding a team, it's really important that you pick team members based on reliability and also complementary skills. In order to figure out how reliable someone might be, just try and work with different people across different case comps at first, maybe in your first and second year, to gauge first how you work in a team and also what type of people you work well with. And then when you're in a team, it's important to assign ownership early and have a way to resolve your disagreements quickly, such as voting and then moving on and to the next step. All right. And then to tell a story across your entire presentation, entire deck, I just have 3 main tips, and that's to first keep it simple and think chronologically, building your argument from your premises to your conclusion. Second is to plan out your slides and use building blocks to develop each of the slides. And then 3 is to maintain a clear visual philosophy throughout the entire deck. All right, so let's just run through a little slide. First thing that you want to kind of think about when you're starting on a fresh blank slide is just to separate that into 2 or 3 columns with overall 3 or 4 sections, and slide masters and the guidelines are your friends, so keep switching them on and off as you go. For example, in this Life 360 company overview, it only needs to communicate 4 things, and there's a good balance between the quantitative and qualitative information. Only the most important insights are highlighted as to not crowd out the slide. Another thing to note is to use consistent headings, subheadings, bylines, shapes, and colors to your advantage, but communicate similar information in similar ways. So, for example, the key statistics and recent financial results all have major numbers bolded and in red, and then there's additional numbers, calculations to the side in a smaller font, and then also what those numbers might mean in a different color underneath. Another thing that's going to be pretty helpful is for color, you should aim to maybe set up your own theme color and use the different brightnesses under the main color. That just makes sure that everyone uses the consistent color, it's easy to access, and you don't have to use the eyedrop every time you want to use the same color. And then finally, make sure that your numbers and conclusions are very clear and very accurate to what you want to communicate in your presentation. So again, thinking about the story and what the overall message that you will be presenting might be, anticipating any gaps and questions that might come from the interview, from the presentation. Moving on to the study tips. What I like to do when I'm quite overwhelmed with too many tasks is to just plan ahead and break down your tasks into bite chunks. Something that you can maybe start in 5 minutes and then keep going, something that you can achieve today or move on to tomorrow. I aim to maybe achieve like 3 to 5 things depending on how large the task is for a given day, and always remember to take breaks in between. And then number 2, what I like to do is choose my environment and choose somewhere that's going to be most effective for you. That might be at home, that might be a uni, might be a cafe. I personally like to study at a cafe because there's other people around who keeps you in check and there's someone to work with as well in your surroundings. And then number 3 is maybe to change things up when they're not working. So if you've been studying at a cafe for too long and you're getting overstimulated, maybe that's when you want to go home and be in your own environment.
Hi, I'm Daniel, and I'm a publications officer here at UQES. I'm a fourth year economics and statistics student, and today I'll go over some tips to help you prepare for Econ 3350, as well as talk about some advice I have on choosing your major and also your courses in economics. In terms of choosing courses in your majors for my Bachelor of Economics friends, the first thing that you should consider is what are your required courses and the semesters that you need to do them in. And after that, you can consider what electives you'd like to do. For the majors, it's slightly easier. So in the 4 majors, they have pretty clearly delineated career paths in terms of where you'd like to go. If you're not sure about which major to do, I would suggest to choose the most difficult one that you think you can handle, just because having something that is a little bit more rigorous tends to open more pathways up for you later down the track. In terms of choosing your economics course electives, I like to think about it in terms of a Venn diagram, where on one circle you have the harder and maybe more rigorous courses that will take a bit more of your time. On the other circle, your interests. So if your interested courses and the hard courses overlap somewhere in the middle, then those are the courses that you want to prioritize, because those are the ones that you'll be motivated to do well in, and those are the ones that will help you out a lot in terms of your future career preparation and getting the most out of your degree. Afterwards, I'd suggest considering those that are most aligned with your professional passions, even if they might not be the ones that are most interesting to you personally. But definitely balance some of those out with some chiller electives that you might find a bit more interesting. So definitely don't overload all the hard stuff in one semester and then keeping all the chill ones in another semester. And in terms of selecting courses, UQES also has a lot of helpful resources. So one resource that we have is the Economics Course Guide, which covers every single course you can choose in the Bachelor of Economics. And so looking at the student reviews and also the scores that they assign to each course is actually really helpful in terms of seeing if the course is what you'd expect, if it's something that you would enjoy, and also if it's something that helps you professionally. And the second piece of resource that we have is the Careers Guide, which outlines important information about some of the biggest companies that you have access to as an economics student, and also when to look out for those recruitment timelines, as well as what kind of skills and course requirements you need to be able to do really well in those sort of things. So now let's go through some tricky concepts and also some ideas that you might have seen and you need to prepare for the Econ 3350 exam. So the course in general is divided into 4 parts. You have your univariate processes, and then you have your variations in terms of modeling when the univariate processes are volatile, and also when they are co-integrated. And then finally, you finish off with the multivariate processes. So as a general tip for preparing for the exam here is that while you might be very familiar with implementing and running the models that you have done in the assignment, and also doing all the tests and interpreting all the results, the exam requires to know things a little bit more in terms of the theoretical details and also working through some of the mathematical derivations. So if you've been skipping over those in the lecture slides until now is a good time to look into those. So for univariate processes, you want to start off with knowing what it means to have a stationary process. So in general, this means that you have a constant mean and you have a constant variance across a time period. And from your assignments, you'll have been very familiar with all the model selection processes, looking at your PACF plots, or your AIC and BIC, doing your Young box test for autocorrelation, your ADF test for your unit roots. But in terms of the exam in particular, of course, you want to be able to articulate these kinds of procedures and these kind of recipes in terms of your model selection and testing. You also want to be able to derive some key results. So for example, in the lectures, something that has been covered is, say, how you go from an ARMA model into an AR infinity or MA infinity process. Another thing, for example, is if you want to forecast 1 or 2 periods ahead, how would you derive that mathematically? And additionally, you want to be able to handle additional wrinkles. For example, if there are a deterministic trend in your stochastic processes, how would you intend to estimate that? The next part is on volatility models. So this is another wrinkle in your univariate processes, particularly in terms of financial data. You need to learn how to spot when you have volatility clustering, which is when you have periods where your spikes are a lot bigger and you have periods where your spikes are a lot smaller. And this happens because in financial data, oftentimes there are some external shocks or factors that means that there's a period of particular volatility and then a period of particular calm. And so that actually in particular fails our assumptions for a stationary process. So a key thing to identify when you're looking at a process being plotted out is to see that the variance, whether it's changing over time or whether it stays the same. If it is changing over time, like it is the case with many financial data, then you want to consider a way to capture that kind of change in volatility over time. And one way that you've learned how to do that in this course is with the Arch and Garch models. And these capture the difference in volatility, but essentially estimating another time series model just for the variance, as you would have done with your ARMA and your ARIMA models for your mean processes. And the key thing to remember here, beyond all of those processes that you would have gone through in your assignments in terms of actually estimating and testing those models, is that you want to be able to derive some of the key results within this section. So for example, you'd want to be able to articulate how the Garch process converts to an arch infinity process, which can tell you about the significance of the Garch model in terms of how we estimate volatility today. And then also think about how do you test for Garch effects with the Bruch-Pagan test, how do you do model selection, as well as knowing some of the theoretical nuances between some of the variants of Garch, such as T-Garch and also E-Garch, which essentially captures the rebound effect of financial data, in the sense that negative news often affects volatility more compared to positive news. Okay, so the third part of 3350 is co-integration, essentially where you have multiple integrated series moving along in the same direction together. Then you want to be able to prove that things are co-integrating. So in that case, your weapons of choice are your Engle-Granger and your Johansson tests. And then you, again, would be familiar with the same model selection processes in terms of choosing the right Ardle model or the right VAR model or VECM model, based on your co-integrating rank, which we'll talk about more in the multivariate processes. The only additional wrinkle in addition to what you would have seen in the assignments and the processes that you would have been really familiar with there is that you want to be able to do some of the theoretical results. For example, how would you convert an Ardle model into a ECM form, for example. And then for the multivariate processes, the most important thing here is really to wrap your head around all the different matrix representations. So once you have multiple univariate, so once you have multiple processes in the same equation form together, then we represent them in a series of matrices, right? And so there are a couple forms of those representations. So you have your var, and then you have your S var, and then you go to your reduced var. So make sure really across what each of those look like. So being able to identify them as one thing, and also knowing how to go from each of those individual forms and knowing what their purpose really is. So what is a reduced var useful for compared to an S var? And then for forecasting purposes, you really want to be able to interpret those forecast matrices. So looking at those eigenvalues and determining if something is a stable process or not based on the computed eigenvalues, and interpreting the values in the forecast matrix. Afterwards, in terms of the theoretical derivation, you really want to be able to understand the VAR to the VECM model specification. So wrap your head around it. It is not the most intuitive thing in the world, but the biggest struggle with the multivariate processes really is just getting your head around the matrix algebra aspect. I'm sure through your assignments, you would have gotten lots of practice of how to actually estimate the VAR model and interpreting the results that come from the various tests and all of those things. But really the main thing, and this goes for as a common theme across the 3350 content for the exam, is that while you might have done really well in the assignment through knowing the process of how to actually estimate the model and interpreting the results that come out of it, the exam just asks you for a little bit more on the behind the scenes, and you really need to get your head around those kind of derivations and those key results which motivate what you've been doing in the assignment so far. So hope that helps, and good luck with your exam.
Hey everyone, my name is Ari and I am the UQES president. I'm going to be running through sort of a foundational intro to the capital asset pricing model and touching on where it fits in with the efficient frontier. So this was a request we had. And then I'll also really briefly go into an extension of CAPM and where in finance literature it has been tested further through, I'll use the example of the Farmer French model as well. So look, the capital asset pricing model, I'll just refer to it as the CAPM. So the CAPM at its core looks at sort of this, think of like a baseline scenario of if two stocks both offer a, for example, 10% return, but one is riskier, are they equally attractive, or how do we weigh that up? And so CAPM gives us a framework for looking into that. And it's sort of a very simple and oftentimes not effective way of applying theory to finance, but it provides a really strong baseline to do so. So to summarize, CAPM is about pricing risk. And so look, what is risk? What types of risk are there? So we look at two types of risk. There's systematic risk and there's unsystematic risk. So when we talk about systematic risk, we're talking about risk that the market faces. So think of like a recession. Think of currently where we're in a, I guess we were more so in a high volatility environment maybe a week or two ago as we go through the Middle Eastern shocks. That's something that the entire market faces. It's not something that a single company will face. So it's a global shock, and we call that a systematic risk. It's something that all companies or a broad sort of representation of the market is affected by. Systematic risk can't be diversified out, and that's a big founding of what CAPM represents. It's that systematic risk cannot be diversified. Unsystematic risk, which is company-specific risk with a diversified portfolio, can be eliminated. So look, then we flow into the efficient frontier. So the efficient frontier is a graphic which shows the best portfolios available for each level of risk. It's pretty much like a menu of all the best possible portfolios. For each amount of risk you can take, it shows what return you can expect. So think of it almost like from baseline econ learnings, like a production possibility frontier, something like that. It's on that vibe in the sense that if you're operating below the efficient frontier, you have essentially gains that are left on the table and which you can access. If you're operating on the efficient frontier, you are maximizing your returns for the risk that you are taking on in that portfolio. And so next is where you incorporate the risk-free asset. And so what a risk-free asset does is that the efficient frontier is just a curve. But as soon as you introduce a risk-free asset, you are now guaranteed a return for no risk, like for example, from a government bond. And so what you end up with is essentially you can combine your risky portfolio with that risk-free asset. And so the best portfolio isn't just any point on the curve. It's a trade-off of like a line, which represents a trade-off between risk and return. This line touches the efficient frontier at a specific point, and that is the market portfolio. So the market portfolio is theoretically a portfolio of all risky assets in the market, and it contains every risky asset any investor can hold. In real life, you think of like the ASX 200, commonly the MSCI World Index is a good example of the market portfolio. And so we come back to the CAPM, and that is that it assumes that once everyone diversifies properly, the only risk that matters is how much an asset moves with the market portfolio. So we introduce beta. This is sort of a summary of what beta looks like and what movements look like. We'll sort of leave that on the screen for a moment. And so beta tells us how much market risk an asset adds to a diversified portfolio. Then we flow into the CAPM formula. So we're looking at the first term, which is the expected return of the individual asset, and that's essentially just the outcome, or the output is the required return on the asset. RF is the risk-free rate, which is the risk-free asset that I introduced before. The expected return on the market less the risk-free rate is the risk premium that the market offers you on top of investing in a risk-free asset. So CAPM says that your required return should equal the risk-free return plus compensation for taking market risk. And so we're going to bring this all together and we're going to explain the security market line, or the SML. This is a graph of the CAPM. So beta's on the x-axis, you've got the expected return on the y-axis, and it shows whether an asset is offering enough return for its market risk. If you're above the SML, the asset offers more return than required, and it's potentially undervalued. Vice versa, if it's underneath, it's potentially overvalued. But if you're on the security market line, you're fairly priced through CAPM. So there's a confusion point between the capital market line and the security market line, and I think this can happen in finance courses. So the security market line that I've just looked at looks at individual assets or portfolios. The capital market line, your risk measure is not systematic risk or beta, it's actually total risk or standard deviation. And it applies to only efficient portfolios, where the main idea is achieving the best risk return combinations using the market portfolio and the risk-free asset. And so back to CAPM, we've explained where CAPM fits in. It's essentially just visualizing a security market line, and that can be essentially expanded to that capital market line, which looks at all efficient portfolios and maximizing risk returns. CAPM tells us a couple of things. It can help us with estimating required return. It can help us with estimating cost of equity. It can help us with valuing companies. And one thing I touched on with the security market line is it can tell us if a stock is underpriced or overpriced. It's got limitations, so it's not perfect, but it's simple, and that's where it's really helpful. Now there are extensions, and we'll just display an extension of this on the screen, and that's just showing that people have tried extending CAPM, and there's extensive financial literature testing these extensions and seeing how different factors can affect it. And it's a great rabbit hole if you're interested to see where theory has been extended, to see how much stronger theory can apply empirically. So looking at maybe a factor of the market, looking at a factor of companies of different sizes, looking at a factor of whether a company is a value company or a growth company. So this is, for example, the Pharma French, and it's an extension, and it's worth delving into if you're interested in the wormhole of financial literature and testing for how theory applies to real finance. So look, we've covered CAPM. We talked about a couple different measures and a couple different visualizations, and we touched on a bit of an extension of CAPM, but overall, it's something that every finance student, can practically regurgitate by the end of their degree. It's very useful. And I hope that has sort of cleared up a bit of potential misconceptions.
Hi there, I'm James. I'm a second year BAFE student and an AV officer at UQES. Today I'll be covering topics from ECON 1050 and ECON 2011, starting with ECON 1050, doing a Lagrangian optimization question. Now, some general advice for both these types of questions and the exam in general, it's a matter of repetition. Doing workshop questions, tutorial questions, past papers under a time constraint is really the best way to prepare for this exam. The exam, what's on there shouldn't really shock you. It will be similar to a complex familiar level difficulty in a maths methods paper. If you're confident in what you've covered in the workshop tutorial and can do it under a time constraint, you should perform really well in this exam. Now, with the Lagrangian optimization, it's a maximization of a function with a given constraint. So the question I've selected to do for this is a firm that has two production plants, and we're actually looking to minimize their cost function given the constraint of work hours. And I've chosen this question because it's like a hypothetical application of this concept. So we're given our constraint, as you can see here, and as well as our cost function. And we build out Lagrangian as given by the formula, which you should have on your formula sheet. So once you do that, you've got Lagrangian, you've got three unknowns, and therefore you need three equations to solve, which you get from your first order conditions. So first you take the derivative in respect to x for the Lagrangian and set that equal to 0, the derivative with respect to y and set that equal to 0. And then you have the constraint with the constant taken subtracted from the left-hand side and set that equal to 0. There you've got your three equations, three unknowns. It's now a case of simple simultaneous equations, which I've solved down here. The second part of this question is to use second order conditions to show that the solution we found is in fact a minimum. And what we do here, the formula for second order conditions should also be on your formula sheet, and it's just up here. You find the double derivative with respect to x, the double partial derivative with respect to y, and then the double derivative with respect to x and then to y, as well as the partial derivative with respect to x for the constraint function and the partial derivative with respect to y for the constraint function also. Filling that out and solving, we find that we're given 24, the number 24, and since this is a positive, this does in fact confirm that what we have found is a local minimum. Now, the final part of this question is to interpret the Lagrange multiplier. Now, the Lagrange multiplier is this lambda value that we see here in our Lagrangian equation. And how we interpret this is it's what if the constraint was relaxed by one more unit. So it's sometimes referred to as a shadow price. And in the context of this question, the Lagrange multiplier is if we had, which we found was 230. So that means if we were given one more work hour, this firm's cost would increase by 230 units. Okay, so now I'm going to cover price floor / ceilings while also touching on deadweight loss to help you guys prepare for Econ 2011. So a price floor is maybe an example that the Australian government wants to protect farmers and therefore sets a minimum price on a good. And likewise, a price ceiling is maybe to help with cost of living pressures. The cap of some essential items they set a price cap to help protect Australians. To help you understand this topic, I'm going to walk through a price floor question taken from a 2025 tutorial. So in this question, we're considering the deadweight loss associated when the government sets a price floor of $4. So first we need to find the competitive equilibrium. We're given a demand function in terms of price as well as a supply function in terms of price. First thing we want to do here is to reverse these functions so it's price in terms of quantity, so that we can therefore represent them on a supply-demand diagram as seen here. Next, we want to find the competitive equilibrium by setting quantity demanded equal to quantity supplied. By doing this, we find that the competitive price is equal to 3 and the competitive quantity is 6. However, because we have given the price floor of 4, we then substitute that into both quantity functions to find that at a price of 4, the quantity demanded is 4 units, whereas the quantity supplied is 8. Now, the deadweight loss might not be immediately visible graphically in a triangle. So how we calculate that, we find the total surplus before the price floor. The total surplus before the price floor is simply the consumer surplus plus the producer surplus. And then after the price floor, it's again the consumer surplus, which has now been reduced to this little area, little triangle here, and the producer surplus, which is this triangle, but then also including this little triangle here, which wasn't previously achieved under the competitive equilibrium. However, we have to, because in the question it says the government buys any excess supply at the price floor, we also have to factor in government spending in this total surplus calculation. So here we find that total surplus is equal to consumer surplus minus producer surplus, as well as minus government spending. So 4 plus 16 minus 16 is equal to 4. And therefore our deadweight loss is equal to our old total surplus, subtract this new total surplus, which therefore equals 14. Now the second part of the question is that if the government takes the excess supply and feeds those who cannot afford it, what must be the total benefit from feeding the poor in order to justify the program? Now the total benefit from this program just simply has to counteract the deadweight loss. So the benefit has to be equal to 14.
Hi guys, my name is Heidi and I'm the Vice President of Marketing in the UQ Economics Society, and I'm a third year BAFE student majoring in finance. So today I'm going to be walking through a DCF with you guys because we were asked on how to do that. I guess like my credentials for that are that, you know, I'm studying BAFE, majoring in finance, and apparently I'm UQES's resident BAFE sweat, unfortunately. And I'm literally sweaty right now because I've just been playing a netball game. So we're going to start by going through a DCF. I've already finished all of the financial statements and I've built all of those out and all of the supporting schedules and everything like that. So we won't be going through that right now. But essentially all you're going to be doing for those ones is just forecasting what you would, you know, assume that revenue would grow by, whether that's just based on like year to year growth. So between like, say, like this year to last year has been 5%, the 2 years after that, like say that's 6%, on average, that's a 5.5% growth kind of thing. The first thing that I have put into my model is the current date. The WACC, which I've calculated separately, but that's just using a WACC formula. You can make that as complex as you would like or as simple as you would like. Your terminal growth rate, which I've also calculated separately, but that's just kind of based on things like GDP, inflation, etc. And then we've got our outstanding shares and our current share price, and the valuation we're going to be doing is for Wesfarmers. And then best practice is to put these little dots in the left-hand column just so it's easier to navigate around the model. Okay, so let's start with revenue. I've already finished the financial statement build, so we're just going to go over to, should be in acquirer financials because this is an old acquisition model. Perfect. So we're going to enter in the 2024 financial year, it was like 2025 financial year revenue. Yep, cool. And then just drag across the formula because that's already been entered. And then we're going to go straight to our EBITDA. Awesome. No, it's up on there. And don't mind my shortcuts, guys. They don't really work properly on this laptop, unfortunately, because it's a Mac. Okay, perfect. And then we're going to go, EBIT. Awesome. Perfect. We've got our tax expense. Where is that? Awesome. Okay. Perfect. Okay. Now we're going to calculate our earnings before interest, but after tax. So that is going to be the EBITDA minus the tax expense. I might actually make that a negative. Bear with me. Okay. That should make all of them negative, so we can just add them up. Drag that formula across. Perfect. So now we have our value for earnings before interest but after tax, because what we want to be doing is, so you've got your revenue, EBITDA, EBIT, you're taking those straight from your financials anyway. There's not really, you know, you're just taking pretty much your revenue minus your just operating costs, then you're taking away your depreciation, amortization, that's just your difference between EBIT and EBITDA. And then you're taking away your tax expense, but we're not taking away our interest expense because this is going to be our unlevered free cash flow. So you want to get to a cash flow that is essentially, we call it like available to all like interest holders. So it's available to both debt and equity investors, not just equity investors. If you take away your interest expense, then essentially what you've done is you've almost like considered your debt investors in your cash flows. So that cash flow that you've calculated is called a levered free cash flow, and that is only available to your equity investors. Okay, perfect. And now we're going to add back our depreciation and amortization expense. That is in my financials. Perfect. In this particular model, I don't have a separate amortization expense. I've just got depreciation. So I'm just going to add that in, and I'm just going to make that a negative. That's how it's been entered into my model. Perfect. Drag that across. Now we're going to take away capital expenditure. Perfect. Okay, that looks a bit better. Now we're going to subtract the change in working capital. So your change in working capital is your current assets minus your current liabilities. We're going to subtract the change in that. So if I go to my balance sheet, so I've put in brackets my change in assets minus change current liabilities. Perfect. So we'll take this one minus current liabilities. and then it's going to be the change. So we're going to take the period before that, which will be the 2024 financial year. Okay. That looks a bit sus, but we're going to leave it. Subtract with one thing. That's okay. So we're subtracting the change in working capital. Perfect. And then we're going to calculate our discount in days, because we're going to be discounting the cash flow, because it's a discounted cash flow valuation. That is the D in DCF. So you're going to take the end of the next financial year and then subtract your current date, which I have conveniently up the top here. And that gives me 36 days. And then I'm just going to freeze this cell here, which has my current date. So then I can just drag across my formula, and it's going to give me my discount in days for all of my years. Because what you want to account for is the fact that we're already, halfway, almost the end of the 2026 financial year. So you want to account for the fact that you essentially are not getting all of that financial year in your valuation. And then we're going to make that a year. So we're going to take the amount of days and then just divide that by 365 days. Awesome. And then, I've forgotten to calculate the unlevered free cash flow. Forgot that important line item. Perfect. So we've got our unlevered free cash flow here. And now we've just got to discount that back, because if you think back to 2411, this is your essentially money in the future, and you want to discount that back to today's present value of that money. So you're literally just going to discount that back by 1 plus, and we're going to discount that by the WACC. You always discount by the WACC. Perfect. All right, now we want to calculate our total discounted free cash flow for the 5 years. So we're just going to add all of those guys up. Cool. And a big check that I always do when I'm doing a DCF, because sometimes I get confused with discounting and stuff, is your present value of the money or the cash flow should be less than what it is in the future. So if it's more, then you've done something wrong and you need to divide it rather than multiply. But anyway, perfect. So we have our perpetuity approach here, which is when you're using your terminal growth rate and your terminal value. So this essentially here is we're doing a 2-stage DCF. So a 2-stage DCF is we're taking these cash flows that we've just calculated here. They're going to be growing at a higher rate. Say that be 10%. Then you're going to drop that back down to a 7% growth rate for the 5 years after that. And then you're going to go to your terminal growth rate. It just kind of gives it a little bit more meat. And it kind of stops you from, dropping straight down to a terminal value after your DCF. But yeah, so we've done a 2-stage DCF here. So this is the present value of our current free cash flow. We've got the stage 2, 5 years, stage 2 free cash flow. And then the terminal value, that's all in present value. This is our present value of the terminal value. And then you add those guys all up and you get your total enterprise value. And then we've also got an EBITDA multiple approach. So with an EBITDA multiple, you're going to take your present value of the stage 1 cash flows, which is the ones that we've just calculated, your EBITDA in your last year that you've done your DCF for. So in this case, it is 6,890. Then we're going to take our EBITDA multiple. Normally you would take this from your relative valuation, but in this case, I was too lazy to do that, so I Googled it. But what you want to be doing is taking your EBITDA multiple from your rel val. But here I've just Googled it and put it in there. And then what you're going to do is you're going to take your EBITDA in your last financial year that you've calculated cash flow for, and then you're going to multiply it by your EBITDA multiple, and then that's going to give you your terminal value. And then you're just going to essentially discount that back. So we've got present value, terminal value, and that gives you your total enterprise value if you add up the value of the stage 1 cash flows and your terminal value, the present value, the terminal value, and that's going to give you your enterprise value. But yeah, essentially, if you don't know what an EBITDA multiple is, EBITDA multiple is literally just enterprise value over EBITDA, and that will give you your multiple. EBITDA multiples as well, if you think about the equation for enterprise value over EBITDA, if you then multiply by EBITDA, you get back to your enterprise value. If that makes it make a bit more sense as to why you're using the multiple to calculate your terminal value. I know that some people can get a bit confused with that. But yeah, so that's how to do a DCF. You would normally also do a sensitivity analysis, which is when you sort of change your terminal growth rate and your EBITDA multiple. And then you like also have your WACC on the other axis for your sensitivity table. And then you kind of, I guess, assess what would happen to, say, if my WACC changed by 0.5%, like what's going to happen to my enterprise value. But yeah, so that's how you do that. Hopefully that helped. Okay, so I'm also going to be running through which models to use when, because we also got asked on that. Okay, so essentially you've got a bunch, like you've pretty much got like infinite amounts of models. I'm sure that like some finance nerd has made some random version of a model somewhere, but they're pretty much all the same, except for you've kind of got like your sort of base ones. So the first one you've kind of got to know about is the DCF, which is what I just ran through. That's probably the most important model, probably most frequently used. That and the relative valuation model as well. So anyway, I'll explain what they are in a second. Then you've also got dividend discount model. Then you'll also have something called an LBO. It always frightens people, but it's not too bad. Then you have an M&A model, which is merger and acquisition, if you don't know what that means. Some of the parts. What else have we got? Precedent transactions. So essentially a DCF, as I've just ran through, that's where you calculate your free cash flow, and then you discount that back to present value and add it all up. And then you're going to take some kind of a terminal value, whether that be a multiple approach or a like a terminal growth rate kind of approach. And then you're going to sort of add all that up, and that gives you an enterprise value. A DCF is when you use a DCF when a company has very stable cash flows. So something like Wes Farmers or like Qantas, like I guess like not now Qantas, but like kind of companies like that, established companies that you know about, they've got very stable cash flows. They're not startups, they're not, they're not banks, because if you have, say, a tech startup that isn't making any money yet and isn't actually getting any cash flow, their value could be a lot higher than what you're sort of valuing it as, because you're just looking at how much money is incoming into their bank account and how much money is like leaving it. If you're looking at something like, say, Apple back in like 1995, like their intellectual property value, extremely high. I'm not actually sure when Apple started, but assume it's that. But then, if you're looking at their cash flows, it looks like they're really, really bad company because they're spending all this money, but they're not like getting any revenue yet. So that's kind of like where you're going to be using a DCF, is when you've got those stable cash flows. A relative valuation, you can use that on pretty much anything that has peers or comparables. The peers or comparables are what you would assume they would be, and they're literally just companies that are very similar to the company that you're valuing, and you take all of their financials and you kind of use them to replicate the company that you want to value. So say you have like Qantas and you're doing a relative valuation, their peers would be like Virgin, Jetstar is owned by Qantas. Maybe you look at like US airlines, maybe Emirates, like Air New Zealand, like all those kinds of things. So you look at comparable airlines that you have financials for, and then essentially what you do with your comps is you sort of look at how similar is this company to the company that I'm valuing, and that's how you're going to weight sort of their valuation based on the company that you're looking at. So if it's not very similar, if you're taking Woolworths and you're comparing that with Qantas, Qantas is not going to have a very high weighting compared to Woolworths, right? So we've gone through DCF, relative valuation, LBO. An LBO stands for leverage buyout. So you use an LBO when you do a leverage buyout. And if you don't know what a leverage buyout is essentially when a private equity, normally a private equity firm, purchases a company with leverage. So leverage buyout, you purchase it with debt. So essentially what like a private equity firm wants to do, They want to take a company, buy it with a load of debt, pay down that debt as soon as possible, and then get out of the company and sell it at a really high value. And since that they've used kind of like that debt, they get a higher return on investment for like equity. So they just want to buy it with a huge amount of debt. So essentially a leverage buyout, if you're valuing a normal company, is kind of gonna give you a base valuation for the company that you're looking at. So it's the kind of low bar that you want to be looking at, because you would hope that a DCF at a relative valuation will be above a leverage buyout. So the next one that you've got is precedent transactions. That is actually when you're looking at similar transactions that have happened. So M&A, what has like a similar company sold for in the past. But the thing is that precedent transaction is going to have a premium compared to different forms of valuation, because you're paying what we call the control premium, which is like, what is the value of being able to take over this company? And that comes with like lots of other sort of parts to it. So precedent transactions. Also got your dividend discount model, which is probably what you've learned in your first year finance courses. That is when you're taking all of the dividends going into the future. You're going, so like, what are your dividends? Add them all up, kind of like a DCF, and then you're just going to discount them back and then sort of grow them at a terminal value. Dividend discount model, literally what you've learned in 2411. And that's how you're valuing something, say like a bank. Because things with banks is they don't have normal cash flows like a company, because cash is essentially how they make their money. So you would never use a DCF on a bank. You would always use a dividend discount model. So if you particularly want to value CBA, do be using a dividend discount model, don't use a DCF. And then some of the parts is what it sounds like. You add up the parts of a company. If you have something that has a lot of subsidiaries, then you need to value those subsidiaries separately and then add them all up at the end. And then an M&A model is essentially, as it sounds, merger and acquisition model. If you're looking at a merger, what do these like financials look like if they're combined with the other merged entity? So if you have Woolies wants to acquire, like, I don't know, like Endeavour Group again. I know they split, but anyway, what do those like financials look like if they're combined? And then you're going to value it that way. So perfect. Okay, well, thank you for tuning in, guys. I'm really happy if you've been able to listen to me talk for this long, especially with a cold. But yeah, hopefully this helps with understanding what different kind of financial models are and how to do a DCF. But essentially it's not as hard as you think it is. Finance is, if you've gotten this far, I'm sure that you can do finance. It's not very difficult. So as soon as like you understand what all the statement lines are, it's all just kind of about filling in the blanks. So you'll be totally fine. And if people start using a lot of big words, it's probably because they don't understand what they're talking about anyway.